The type of investment returns that you achieve early in retirement make an enormous difference in your portfolio, in the confidence that you have in your retirement plan working. The returns that you get early in retirement matter the most. I'm going to show you why, and then I'm going to help you figure that out coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. Okay, so this idea is called sequence of return risk. No one talks about this. No one talks about this. All you're thinking about is, how do I get to retirement? How do I get to the right portfolio value with all those 5 factors that we've talked about before? How do I get to the point where I'm ready to retire? But it's the actual investment returns that you achieve very early in retirement that can set the difference, that can make all the difference between you having a very successful retirement or potentially running out of money too early. So we're going to dive into this, and then I'm going to help you figure out how to neutralize this risk for your situation. Okay, it's called sequence of return risk, but it's basically the timing at which you have certain returns in retirement. So we're going to go through a scenario. It's going to be the exact same scenario, but we're just going to flip-flop returns. All right, scenario number 1, you've got $1 million saved up for retirement. And on top of your Social Security and pension and whatever else, you're drawing $75,000 a year out of your portfolio. Now, this scenario is where you start with good investment returns. So you can see here in the chart, you start year 1, you've got a 17% positive return in your investments. That's wonderful. Year number 2, you have a 13% positive return in your investments. Great, I'll take it. Year number 3, 8% return. And so after 3 years, this is when it starts getting ugly. In year 4, the investments go down and you lose 5% that year. And then in year 5, it's another down year, you lose 8% that year. You started with $1 million, you withdrew $75,000 a year out of your investments. The average rate of return over that time, over those 5 years, was a 5% annualized rate of return. You would see that and say, yeah, that's not that good. But at the same point, moving forward with interest rates being low, that might not be out of the question. So you averaged 5% a year, but over those 5 years, you started with really good returns, and then the last 2 years were negative. But your $1 million, after drawing $75,000 a year out of it, you finished with $869,000. Not too shabby. Not too shabby. That's scenario 1. Let's go to scenario 2. It's the exact same situation. You've got $1 million to start retirement. We're going to look at the first 5 years. You're going to withdraw $75,000 a year out of your portfolio. However, the return is still going to be an average of 5% over those 5 years, but the sequence of those returns will be the exact opposite. You start year 1 with a negative 8% performance. Year 2 is a negative 5% performance. And then things start getting better. Year 3 is that same 8% positive performance, then a 13% positive year, and then year 5, you have that big year and you gain 17%. Same scenario. You started with $1 million. We're looking at the first 5 years. You took $75,000 out to supplement your Social Security, and you averaged that 5% rate of return. But because you had negative years at the beginning, even though the average is the exact same, you end with $758,000. Guys, if you look at these 2 scenarios, they are identical, and you don't have any control over starting with good returns or starting with bad returns, but that's that's about $110,000 difference of real money difference in your ending portfolio value after 5 years. Just 5 years. That's a $110,000 difference in your portfolio value. Same amount withdrawn, same actual rate of return. It's just the sequence of that return is absolutely reversed. Wow, this is a big, big, big deal and represents one of the biggest retirement risks that you're going to face. So, right now, we're in this pandemic, And the stock market has absolutely surged due to all the money printing. More and more people started this year thinking, well, I might want to retire soon. They saw the pandemic and said, I don't know if I'll ever be able to retire. And now many people, as they're seeing their investments soar, are saying, well, I'm ready to retire right now. And as you're seeing your investments soar, and you're listening to me tell you each day, hey, listen, I'm optimistic about the stock market, but cautious because valuations are as high as they've ever been, second highest ever on record. We've got all sorts of signs that suggest, hey, even though the stock market could continue to run higher, could stay high for several years, the likelihood is the market's expensive. And so we might see very volatile returns in the future. We might see potentially lower investment returns in the future than normal. If you tie that right now to this sequence of return risk, if you're planning to retire soon, you've got a greater threat. There's a greater risk that you could retire into this bad scenario sequence, okay? So what do you do? How do you address this? Number one, you have got to be doing comprehensive financial planning. You've got to be doing comprehensive financial planning. This is not self-serving. We do comprehensive financial planning, but we can't serve everyone on the planet. This is not self-serving. The way to figure this out is you've got to do a full 5-factor retirement analysis and complement that with your overall investment strategy. When you're looking at all 6 areas of your financial life connected together, you can figure out how to best plan for sequence of return risk. Also, in that comprehensive financial plan, you're going to do that 5-factor retirement and you're going to do a statistical simulation. They call it Monte Carlo, to take a look at, well, how confident should you be in your ability to retire right now, even if sequence of return risk is a threat to you. So that's number one, the first way to solve this, do comprehensive financial planning. The second way to solve this is what we call here personal pension plan. You've got to look out over the next 10 years of retirement, if not longer, and figure out what dollars are you going to be spending in the short term, what dollars are you going to be spending in the intermediate term, and then what dollars are long term. And when you do that, you then isolate how much risk should I take with these short-term dollars? Well, not a lot. How much risk should I take with these intermediate-term dollars? Some. How much risk can I take with these long-term dollars? Well, you can take a lot of risk with those. When you stratify your portfolio into the amount of money you're going to need in the short term to supplement your Social Security, amount of money you need in the intermediate term and the long term, then you're able to withstand the first few years of retirement being negative. If the first few years of retirement are negative, but you're just drawing out of cash and those dollars didn't go down, you've got time for your long-term dollars to make up that difference. That personal pension plan is what we call it. Others call it the buckets of money approach. Work with your certified financial planner to implement that strategy. That's the second. The third, you hear me talk about all the time. You've got to have an investment strategy that takes into account multiple philosophies. If it's just diversification, if it's just I'm going to not have all my eggs in one basket, you're going to be missing out on some key ways to manage this sequence of return risk. If the stock market starts going down, international investments are going down, gold's going down, bonds are going down, real estate's going down, as we've seen during these crisis events, if the only thing you have is diversification, then everything's dropping at the same time. And as we saw with the sequence of return risk, when everything's dropping at the same time, you can be left very vulnerable in retirement. You need to complement that diversified strategy with a momentum strategy, that if everything starts falling, you've got an escape hatch and things can go to cash. Or when everything's moving up, you can transition into the areas that have the most momentum and gain even more ground when the rising tide is lifting all boats. You should have a diversified strategy and complement that with the momentum strategy. That's exactly what we do here as well. It's extremely, extremely important as you're entering retirement, early on in retirement, and throughout your retirement. So, sequence of return risk, this is real. You can check my math. In reality, I've seen it play out. Work with your certified financial planner, build a plan, stress test it. set up your own personal pension plan and make sure you've got an investment philosophy that works no matter if the stock market delivers great returns early in retirement or negative returns early in retirement, that it doesn't impact your ability to retire with confidence. All right, reach out to your certified financial planner. If you don't have one, you can contact a member of my team. Find us online, wisemoneyshow.com. Also, Korhorn.com, that's Korhorn with a K. You can give us a call as well, 574-247-5898, or send us an email, info@korhorn.com. All right, there you have it. Go out and take your next wise step in your financial life.